Yes, guys, welcome to the next video. So in this one, we're just going to be looking at some confirmations, and in particular, institutional orders and volatility. So if you remember in our technical section where we actually looked at some confirmations, it's a different type of confirmation here because we're actually looking at fundamental confirmations. So we would obtain our directional bias, understand it because of our, whatever reason it may be, whether it's monetary policies, whether it's data, some kind of GDP data, CPI, whatever it is. This will be the final step before you actually understand your bias, your complete bias. And of course, you can make the next steps to actually enter the trade. So first things we're going to look at is the institutional orders. So it consists of two components. You've got commitment of traders report, and then you've got open interest. So for commitment of traders report, also known as COT, um, it's understanding the order sizes of types of traders and institutions into certain asset classes and currency pairs. So what this report is, it's a document that shows every single recorded order in the market. So if we're looking at the euro, for example, it will show how many orders have gone through for the euro. It will show how many orders have gone in for sales and how many have gone in for buys. Then when it comes to open interest, it's simply a line chart showing the amount of orders on an asset type. So again, if we take the euro example, it's going to be a line showing how many people were actually in trades at that moment. So how to find all this information? There's two ways to get it all. The official way is to go through the CFTC website, and the second way is going to be a lot quicker that I'll explain. That's the one that I usually use if I do look at COT data. So you go onto the website, the CFTC website, go to the market data and economic analysis section. Then you go on the left-hand side to commitment of traders, scroll all the way down to the bottom of the page. Eventually, you're going to get to this part, this subsection called current legacy reports. And the part that we're going to be looking at is the Chicago Mercantile Exchange, and then futures contracts only, so not futures and options. We're going to be looking at the short format. The long format has all the different types of data, but the main one that we'll be looking at is the short format. And this is exactly what it looks like. So of course, at first, it looks very confusing. You don't really understand what's going on because it's all the numbers, but let me just break it down. So in this case, we're going to be looking at the JPY futures contracts. Here it shows the date. The code is relevant to the type of future market that it is. Now you've got non-commercial, commercial, and then total. And then non-reportable positions is retail traders like me and you, for example, where our trades do not even create a blip in the market. In terms of non-commercial, this is the one that we're going to be looking for because that is actually the banks and all the larger institutions, and they're called the non-commercial. The commercial are the guys who are the businesses, for example. So they would buy that future contract or whatever it is as a trade. But in fact, this has a direct effect in their marketplace. So if they're wanting to export something and buy something or import something from Japan, for example, they would have to purchase some JPY contracts or JPY currency. And that's what the commercial side is. The non-commercial is the banks, as I've said. So if you look at it, you've got long, shorts, and then spreads. Main part again is going to be the long and the short position. So that's obviously buy and sell positions. Then you've got contracts of JPY, 12,500,000. So I believe that's the total amount of contracts that there are. Then if you look at the breakdown of it, this is the part that we're going to be looking for. So as you can see, JPY in the recent week. So just to let you know, the COT data, I believe, comes out once a week, sometime at the end of the week. So it also depends on the week that's just passed as well. So it's not that it's predicting the orders that are coming through for the next week, but it's going to be for what's happened previously. Now, of course, this is good in terms of looking back, but in terms of looking forward as well, you may not see a massive increase or decrease in the contracts because they're so large anyways. But roughly, this is what we're going to be looking at. So in this case, we're seeing that more institutions are long in, no, more institutions are shorting and selling JPY contracts than they are long in. And this is what we need to know. As you can see, percent of open interest, you've got 48% of the orders going through going to shorts, and then longs are 13.8%. This is exactly what we're looking for. Now, note one thing before I even move on to the second page, but a COT report is simply an extra confirmation of our bias, because what a lot of retail traders do is they know about this COT report, but when it comes to understanding it, they see, oh, okay, now we've got more JPY contracts as shorts rather than buys. Therefore, I should keep on shorting JPY. However, this isn't the case. What actually moves the markets, of course, is going to be that change in contracts as well. And of course, when you actually look at fundamental bias, the other factors that we look at, as I've explained throughout the whole thing, whether it be monetary policy or whatever, this is the more important thing. But the COT report is a great way to actually quantify how the market is moving, where all the orders are going through, and also put into perspective when you're comparing different types of economies. So if you can see that more JPY contracts are being sold, and then, for example, here you've got Euro, more contracts are being bought, then you can assume that Euro JPY will be buying. However, you've got to always look back to your other resources and everything that's going on in the economy, and do not use this as the simple go-to, because it can be very misleading sometimes, because these are contracts that happen over a long period of time. So it's not going to help you, intraday and on the 1 hour time frame, for example. In terms of the second website that we use, this is if you want to quickly and briefly look at it. I've got the link over here, so just type that in, obviously to Google or whatever you use. It's just going to be this, obviously showing it just a bit cleaner, and then of course got all the data right there. Now moving on to the second part that we were looking at was open interest. So as I've explained, it just shows the amount of interest in that market and the amount of orders that are going through. So the way you look for this is go on barchart.com, and then at the top or down one of any of the spreads here on futures, then you can look at the different options that you've got there. In this case, I've looked at the Euro FX September 2021 contract. So if you remember from one of the videos where we briefly went over barchart.com, there's different types of contracts. So this one is the September 2021. Then that renews. You've got the October one, the November one, the December, that keeps on refreshing every single month. But because this is the most relevant to this time, we're at the end of August and we're getting into September right now, that's the one that we'll look at. So when you open up the chart, so this is when you search, and then you open up the chart through here, press full chart, and this is what you'll get up. What you've got to add is go to the study area right here, add in open interest, and that will come up. The open interest line is that pink line. At the bottom over here, we've got the COT data. So remember how we had all of this in number form? You can have it in a graphic form right here. And the way to do that is you press that plus study sign. When you go onto it, you just type in commitment of traders, and that would come up right there. So how do we actually use the open interest line? So as you can see right here, we're on the 6-month time frame. As you can see right there, you've got the different ranges right there. We've chosen the 6-month timeframes to have a longer term perspective. Now, what the open interest line is going to show and represent is what happens at certain stages in the market. Now, right here, we got to a certain stage where price eventually started to sell off completely for the euro. Now, I can't remember exactly because I have to do my research on it, but for some reason, the euro sold completely at that point, whether this was spurred on by fundamentals at the time in terms of interest rates, in terms of other types of monetary policies. Clearly, there's a reason for that. Now, if you were trading during that time and you saw the monetary policies actually play out like that, and you expected to see or to keep on seeing sells, one important thing you could have done is to actually look at this open interest graph and see what was going on. As soon as you start to see this open interest start to spike up, what does that mean? Interest in for the euro contract is building up. Therefore, so you're not going to understand whether it's building up for buys or the sells. So you just understand the contract amount is increasing and the open interest is increasing at that time. And what can we expect? Because we're looking for sells, we can only assume that that open interest is for the sell bias. And that's exactly what happened. Now, how to use this now? If we start to see a change in fundamentals, and for some reason we expect buys, for example, whether this is increasing interest rates, therefore the euro contract and bonds or whatever it is more attractive to investments, therefore you may see euro start to buy. Obviously, I'm not saying that right now, but this is what you can expect. If we start to see that happen, open interest will drop and then eventually rise when you start to see the buys happening. The reason it will drop is because once you're in this consolidation area, the sales that have continued at this point, the open interest for that is going to drop. So what does that mean? The line is going to drop as well. Once you get that drop in line and then the change of the shift in trend, when you start to see the buys, that's when you'll start to see this open interest go back up. So like I've said, how to use these confirmations. Overall, using both the open interest and commitment of traders report can help long-term understanding of what institutions are doing in their open positions. Now, the important thing here is to already have a directional bias before you get into any of that and have these two confirmations as simply just an extra step. They will confirm your bias. So as you can tell from the open interest, it's only really effective on the higher time frame, whether it be 6 month, 3 month, whatever type. But the COT report is more of a weekly thing. However, because the contracts are so large, you can't expect it to change drastically every single week. So yeah, the COT report, something that you could look at weekly, but personally, I would usually look at it monthly and when I'm really trying to get a grip on fundamentals at the time. So as I said from the start, we're going to be looking at the open interest, commitment of traders, and also volatility indicator. So for this, we use something called the Euro FX VIX. You would usually type this contract in as a dollar EVZ. Now, what this is simply a chart or a number to show how volatile the markets are at the moment and is it a good time to trade. If the number is less than 8, it shows low volatility in the market. If the number is more than 8, it shows good volatility. Now, where can I find this? So you type in barchart.com again. Obviously, now guys, you can see how useful this website actually is. And you type in the Euro FX VIX, and it should come up on Google straight away. And this is the link for it if you want to type it in. Once you get that open, you've got the main area right here, Euro FX VIX. The main part that we're going to be looking at is the chart right here. In this case, at the moment, it's coming towards the end of August in 2021, and this is the reading we're getting, 5.27. Now, what have we just said? If the number is less than 8, it shows low volatility in the market. By volatility, it says volatility because it's a volatility indicator. However, what we actually mean is liquidity, you know, um, how many orders are going through into the market and everything like that. So because we got 5.27, therefore we can imply that the market has low volatility as expected during the summer markets. Therefore, using this information, you must understand to be careful and reduce the risk in the market. If we push this chart onto perhaps September or October and November time, when liquidity in the market actually builds up and there's more orders, you're going to see that this number will actually rise. And that's when we know we want to be in the market at the time, because you're getting them orders and you're going to have really clean order flow. And when you relate this to your technicals, you'll be really able to understand it well. So yeah, guys, all this is simply just some extra confirmations that you need to look at. Might be a bit confusing at first because there's a lot to actually grasp and understand. However, when you actually spend some time on it, which I would highly recommend, just go through all these reports. Link that also to your charts as well. So if you're seeing, for example, more JPY shorts, less JPY longs, see, does this actually translate into the market? It's not going to do 100% of the time. However, this is sort of an indicator that we can always look at. So yeah, guys, that's it for this lesson. It was a bit of a long one, but I just wanted to make everything as clear as possible. So yeah, guys, take care and I'll see you in the next video.